everyone. Thanks for joining today's webinar, Preparing for Audit and IPO Stock Plans. You will see your webinar pane in front of you. Please note that the orange arrow will allow you to minimize or maximize the pane. If it is minimized, simply click on the orange arrow to bring it back. Feel free to submit any questions that you have for our presenters throughout the duration of the webinar. Our presenters will handle questions at the end as time permits. If you use your telephone to listen in on our webinar, please make sure you select Use Telephone. If you're listening through your computer speakers, please select Use Mic and Speakers. If you have the incorrect setting selected, it will produce an echo sound. And with that, I would like to jump into what will help you qualify for California CE. To qualify, you must use a personal computer and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions, and complete the evaluation survey at the end of the webinar. All right, let's begin to talk a little bit about our presenters. First, we have Matt Peralt. Matt heads the SEC and Technology Audit Practice at Armanino. He has over 20 years of experience and has supported over 50 technology sector transactions. Matt has industry experience as controller and VP of Finance, and prior to Armanino, he was working with Ernst & Young. Next, we have Scott Shorts, who's a senior manager at Armanino. Scott helps lead the Equity Management Solutions practice and has worked in the legal and financial industries, providing financial and consulting services to public and private companies. Scott also has extensive experience in equity compensation as well as valuations. With that, let's cover today's learning objectives. Today, participants will list steps to prepare for the audit of your equity sections, recognize many of the risks and penalties involved in stock option accounting, identify equity award modifications, as well as review accounting standard updates. The presentation overview will cover audit preparations, interacting with auditors, modifications, IPO-specific readiness, as well as accounting guidance, updates, and proposed updates.
Thanks, Sartaj. This is Scott. We definitely have a lot to cover today, and I know we have a broad audience, both private and public companies, as well as finance accounting folks, HR folks. So we do try and cater to all of you. We also have some slides that we're not going to necessarily be diving into, but are more takeaway slides for you to review and use the presentation as you go forward. So we're going to start talking about some of the risks and issues. If you're a stock plan administrator out there, you probably know these, but others that maybe just have more of a single focus of HR, accounting, or legal, sometimes forget that the stock option administration and accounting functions really go across all of the organization, as well as outside providers, valuation firms, consultants, etc., outside counsel. And so there's a lot of risk involved because of all the facets that go into stock option administration and accounting. One of the keys is to balance the low-cost solution, the spreadsheet, versus risk, right? How risky is a spreadsheet? Maybe if I'm a very, very early stage company, it's okay, but once I'm beginning to get audited and move forward along my growth path, more risk, SEC risk, etc. as we go. We always harp on this is processing transactions in the moment. We all get busy, and a lot of times we'll forget, hey, there's an exercise today, I might not process it for a week or two, and what are the ramifications of that? Doing things in the moment as much as possible, when possible, is key, and it's definitely going to help keep your option plan in sync and cleaner, and we're going to talk about other ways to keep your plan clean. Love this quote. This is actually one of our clients who said this. Basically, you get a lot of flack for doing things wrong, and you don't get a lot of praise for doing the stock option reporting right. But even more reason to try and get it right. So we're going to talk quickly about a case study, and this is a real event, and I don't know if that client's on the webinar today, but I'm sure they'll laugh if they see this. But ultimately, this is a case of a non-employee consultant who was working with the company throughout their startup phase. At some point, the company terminated the consultant or believed that he or she was no longer providing service. But once the company went public, that consultant kind of came out of the woodworks and said, hey, I'd like to exercise my options. How do I do that? The company felt that the 90-day exercise period had expired, et cetera, and there was some disconnect on what a proper way to inform the consultant that he or she was terminated and could no longer exercise. Some of the issues that came up were what was in the original agreement, also separately what was in the consulting agreement. Sometimes those they may say separate things, and ultimately in this case, the company ended up just settling with the consultant by giving him or her a fully vested stock award. I think it was a gentleman actually, in their public company stock. So, it wasn't a huge impact to the company, some stock-based comp they had to take, but more of a hassle because the whole comp committee is going through that, et cetera. Some of these items, too, are not just lawsuits or litigation. I know, in recent years, a lot of our case studies have been on that, but, other items that we've seen is just data missing, right? So in ESPP payroll, a group from, Asia or EMEA might be just missing from your ESPP estimate, and then that impacts your accounting and, again, has an impact on controls that we're going to talk more about today and the accounting that you recorded. So we're going to dive into our first polling question now.
Let's take a look. So the first question is, which of the following have you done this year? Is it A, option repricing, B, extended participants' time to exercise post-termination, C, accelerated an award, D, completed a merger or acquisition involving equity awards, or E, none of the above? So we'll give you just a few moments to make your selection. Make sure to select all that apply. All right, with that, let's go ahead and close the poll.
So it looks like a variety of activity, but more than half of you haven't had any of these events occur, which makes things a lot easier for sure. Repricings, we'll talk a little bit about repricings and some of the other modifications. For those of you that did have the B and C events occur, hopefully you took some incremental expense or at least did an analysis on the modification, because there is some accounting impact aside from maybe tax or just administrative impact as well.
So, hi, this is Matt Peralt. So as the audit partner, the person that we're typically interfacing with during the course of stock options and evaluating the plan is somebody at the controller level or maybe somebody in stock administration. Certainly as the stock admin, you've probably read through the plan and understand it, but if you're the controller in a startup organization or getting ready for an IPO, it's likely you don't have a full-time stock administration person. So certainly one of the things we recommend is reading through the plan document, understanding the terms of it. Oftentimes you'll get a plan that is expiring and has been replaced by a new plan in anticipation of the IPO, just sort of a cleanup exercise that happens. So you want to make sure you understand those shares that are coming out of the expiring plan, how they're being treated. Are they rolling into the new plan? And certainly before the company gets ready to go public, you want to firm up your policies and procedures and make sure that you're managing the various types of grants. Often, as Scott said, in the early history of startup, you're going to have a lot of grants that are made on special terms that don't necessarily map to the plan document, and you need to understand that the special grants that have been given, the terms and conditions on those often override your stock plan. So you want to make sure you've got a good summary of those, and that there's documentation that supports the communication of terms, because for stock option accounting, the grants are not considered granted until both terms all the major terms are known and understood between both parties. So oftentimes that takes place in an email exchange, perhaps outside of what's maintained in the company's documentation. So make sure you do your exercise and read through the plan and understand what's been communicated to the employees.
Yeah, a couple other things too is understanding fair market value and release dates. Right? Is it going to happen if it happens on the weekend? Or vesting happens on the weekend? Is that going to go back or forward a day? Those things are all important as well. As Matt said, just to understand the documentation.
And then in terms of processing procedures, Scott touched on this earlier, but certainly the stock administration function flows across human resources, finance, payroll, and often in the early days it's going to be executives writing things on the back of napkins that are agreements with their early stage employees. So you want to make sure that you've gone through, documented, and made sure that you've got evidence for everything that's going to be part of the audit function. And so here we're just talking briefly about some of the areas that you should be looking at and making sure you've got documentation that was done contemporaneously, and if it wasn't done at the time, now's the time to make sure that you confirm those terms that are in place. Big component of early stage companies and granting stock options is just making sure that you've got a valuation done that is going to be used for the basis of determining the fair value of the shares that are granted on those dates. Typically for accounting purposes it's referred to as, or for IRS purposes it's referred to as a 409A. So you want to make sure you've got the valuation done by a qualified third party, that the valuation can serve both your tax and audit needs, and one of the components in that valuation should be a 5-year cash flow forecast. So you want to make sure that that's reasonable in comparison to the actual history of the company. Make sure that there's not big fluctuations in comparison to actual numbers as you're going forward. And one of the things we highlight here is making sure that your valuation firm is involved in signing off on that report before you actually grant options. Make sure that the reports, the 409A reports that you're getting done are done at least annually, more frequently as you're leading up to the IPO, and then certainly any major events that the company goes through. An example of that would be signing a big customer contract, getting FDA approval, going through a clinical trial and getting a positive result. So you want to make sure, again, that you're getting those valuations done timely and that they are high-quality reports.
All right, with that, let's jump into polling question number 2. So the question is, which of the following equity awards does your plan allow? Is it A, options, B, RSUs, C, phantom shares, D, stock appreciation rights, or E, not sure? Just as a reminder, you must poll at least 75% of the questions to qualify for CE credit. I'll give you just a few more moments. All right, with that, let's go ahead and close the poll. So options is definitely leading.
Yeah, interesting. Restricted stock. We've definitely seen a rise in the use of restricted stock over the last several years as folks want to get away from some of the negative tax consequences of options, where if you do an early exercise or an exercise without actually selling the underlying shares, you can get a nasty tax consequence. And oftentimes, if there's big fluctuations in the value of the options, it can be a sort of a detriment to the employees. So we're seeing just that aligns with what I'm seeing in the marketplace, just more grants of restricted stock.
Yeah, I'd agree as well. So talking a little bit more about documenting your controls, I mean, you're going to kind of see that as a continuous theme. And number one, when Matt and I were talking, he wanted me to correct the first one, but ultimately it's documenting that you actually have documented processes, right? Providing that you have written processes. How do you go through from, from a offer letter through to the board minutes, through to then an actual grant agreement? Is that a documented process? Is that something that's written? Is that something that changes for every time you do an offer letter or a grant? Ideally, that's consistent, and that's something that when you then present it to the auditors when they're doing their testing, or if you're doing SOX testing, then you can demonstrate that you have a control on that when you're granting somebody employment, you're giving them an offer letter that you make sure that gets into the board minutes or the comp committee meeting and ultimately gets granted and everything is in line there. We've seen a number of cases where that process alone gets missed and awards get missed, and it's very troublesome for the company because it's not only missing on the accounting, but you may have an employee that doesn't get the shares that they deserve. And ultimately, everything we're talking about is an incentive for your employees, right? This is an equity incentive. So that's the goal. Another thing that the auditors are going to want is a reconciliation of the comp committee or board minutes, back to your system or your option ledger to ensure that all the grants are included. And we get this question, it's general in the PBC list, is how can you demonstrate that you communicated in a timely fashion to your employee after the comp committee or board meeting, and that they accepted that award? Because ultimately that may play into when is the grant date established. If you're waiting 6 months after the board meeting to actually tell the employee they get a grant, there are some issues with that potentially. And you should know that if you are doing this in Excel today or maybe through your outside counsel, through paper grants, there's systems today that can very easily make this an automated process. Whether you convert to an entire equity system or even just using DocuSign or EchoSign, you can make this process more automated and have more documentation around it. And we were talking about grants. For those of you that are granting ISOs, just be aware of the $100,000 limit. I'm not going to go through this slide in detail, but it's a great takeaway slide or to be pinned up in your office just to make sure you're tracking everything properly. A lot of times we see ISOs granted to non-employees. Board members, non-employee board members are still non-employees, so they can't receive or gain the tax benefit from an ISO either.
So certainly getting ready for the audit, you're going to want to have an audit checklist. And the old adage, an ounce of prevention is worth a pound of cure. You want to make sure that you invest the time first to identify who is the point of contact for the auditors, who's going to gather all of this information, identify what it is that you need to prepare before the audit happens, and then make sure that you gather and organize all these documents in a logical manner so that you're audit ready.
And we do have a checklist available. If you'd like that, go ahead and you can put that in the survey at the end, and we can definitely send you out the audit checklist that we have.
So this page and the next really provide some examples of documents that you're going to need getting ready for the auditor. We've already talked about the stock plan, any amendments to that plan. Make sure, oftentimes the plans are lasting 10 years, so if your company is older than 10 years, it's been around that long, then chances are you've got one stock plan that's expired and then it's been replaced by a new one. Scott talked about making sure you've got all the board minutes, at least the ones that are focusing on compensation. Make sure that those are reconciled, sample of grant documents. And again, anything that's unique or different is something that you're going to want to focus on. And if the grant documents extend outside of a specific stock option, you've got an employment agreement that has something written in there that speaks to the number of shares. You're going to want to make sure you look through that. We've talked about valuation, and one of the elements certainly as you go through, and most of the options are going to be granted and fair valued using Black-Scholes, so you're going to want to document the significant assumptions that you put in there for option life, for volatility, and interest rate risk. And one of the best practices we recommend is just writing up a simple memo describing the process that you went through when doing the accounting. 85% of circumstances you're going to use the same assumptions for all of your employees. You're not going to break it out into differing categories. But certainly the distinction here is that for employees and non-employee directors, the grant date fair value is going to be what is used. And then for non-employee consultants, again, early in a company's development stage, you're going to have typically a greater number of consultants that are granted options outside of a company plan, and therefore those need to be valued continuously as they are earned or as they are vested, and so you need to re-update the assumptions that you're using. If you're using a Black-Scholes model, then every single quarter, perhaps as these vest or when the employees perform the service, you need to make sure that you're updating and documenting those assumptions. And then making sure that if you're using different experience groups for different forfeiture rates, that you've got a logical basis, not just in the historical evidence, but why that's going to be a good predictor of what's going forward. So anytime there's something unusual to the plan, or anytime you're developing these assumptions, you want to make sure that you've got at least a brief memo in the file that just sort of walks through where you pulled the data from and why it's reasonable.
Yeah, and just a quick note on that, right? Usually a forfeiture rate is going to be analyzed once a year at least, maybe quarterly, depending on how often it's changing. And that's an analysis that the auditors are going to expect that you've done. If you have a lot of history, you may need to also do an expected term analysis using a historical expected term versus simplified method. One thing also on the forfeiture piece, just real quick, because this came up today in a new company we started working with. For those employees or even consultants, if somebody has vested, we're not going to reverse vested expense. You're only going to reverse expense for those unvested shares that never vest. So just a little quick tidbit. If you have an employee that terminates but they're 50% vested, so you've expensed 50% of their award, you're not going to reverse that 50% of expense. So hopefully we all know that, but we've seen it happen a couple times.
And the other thing to keep in mind for non-employees and consultants, you don't as you would for employees, you would take the option, the expected exercise option versus the entire life of the option, which is typically 10 years, and come up with your expected duration. But for non-employees, you're simply going to use the duration of the option life, which typically is 10 years, and so that typically results in a higher expense component than you would for the other two categories. And then if you've, as a controller or CFO, if you've looked through the financial statement footnotes, certainly for private and even more so for public companies, there is, typically your ASC 718 disclosure around stock compensation is one of the lengthiest disclosures in all of the footnotes. So you've got to come up with a lot of supporting schedule. You're going to have a significant number of data sources. One of the things to keep in mind too is that because this is a non-routine process and it cuts across so many departments and it involves complex calculations, it's an area that's subject to increased risk. And the key there is certainly if your audit firm comes in and finds something wrong, they're going to help you correct that. But chances are you could get slapped with a material weakness, and that's something that no company getting ready for an IPO wants to have to disclose in their financial statements. Again, these pages just walk through some more of the disclosures that are required around stock comp, and if you look, some of these numbers that are included in here, and I don't know how the FASB guides came up with some of the requirements for these numbers, but again, it's something that you're not going to calculate on a regular basis, and therefore the likelihood is that you'll get them wrong. Make sure that you're not just pushing the button. If you do have a stock option accounting system that has reporting capabilities, make sure you're not just pushing the button on those reports and then turning around and handing them to the auditor. Make sure that you're capable of recalculating those amounts, or at least walking through the mechanics of the reports and understanding how the system is generating those numbers. Again, just some more of the financial statement disclosures that you're going to need to prepare. Make sure that certainly when you're running the reports, one of the errors that we've seen is just the settings on or the filters that you can run on the reports. Make sure that you've got the right parameters set on those reports so that when you're running them, you understand that it's encompassing the proper amount of data, so you're getting the right disclosure. And typically you're going to need to do separate disclosures for employees and non-employees. So that's one thing to think about when you're running these reports. We've talked about this again, but make sure that you've got a defined and documented process. Most companies are taking advantage of the SOX exemption leading up to an IPO, so they don't need to have their auditors come in and do a formal SOX evaluation, but management is required to do their own internal analysis of whether or not the company has controls in place that work. And if you get a letter from the auditor saying that your controls aren't operating effectively, then I think management cannot arrive at any other conclusion than they weren't. So again, something to be aware of. And just make sure that you understand these reports. Make sure that you know, in many cases, if a company's been around for a significant period of time, they're going to have a lot of option activity. Scott and I talked earlier about modifications and just the volume of additional data that creates inside of the system. One important thing that I always go through with companies getting ready for an IPO is, you know, just how are they valuing options that are granted between 409A dates. And again, oftentimes in the system, the company has historically just continued to update the system each day with whatever the fair value was on the last 409A date. But many times the auditor is going to demand that you do an extrapolation or an interpolation of the values between those two dates and then go back into the system and write over those value dates to make sure that you're getting sort of a straight line between the value dates unless something significant happened in the company. So make sure you understand the auditor's preference on these things, and then certainly if you start encountering areas that are complex and outside of your area of expertise, make sure you're thinking about bringing in a third party that has not just the experience dealing with the option grants and all varieties of those, but the systems that will make your process a lot easier to define and document on a go-forward basis. Make sure you're connecting with the auditors before the S-1. During the valuation process, we talked about this. Make sure you're looking at the 409As, that you're having the audit firm bless those before they go final and before you submit them to the board for approval. Modifications, we're seeing an increasing volume of those with the improved economy in Silicon Valley. If companies are having up and down cycles leading up to the IPO, in order to retain their employees, they are repricing many times, and so these modifications that happen oftentimes to accomplish it in the system, you're going to replicate the option grants in the system so that you've got that old stock comp continuing to amortize and then new stock comp component coming from the modification. So you want to make sure that you sit down with your auditors, they understand how you've entered this data into the system. And then cheap stock, obviously, again, if you're granting options that are cheaper, have a strike price that is below the fair value as determined by your 409A, then you want to make sure you've done the calculation. That's something the SEC is scrutinizing very heavily 18 months before the IPO. They want to make sure that you've done your homework and haven't given away any cheap stock options. And the last item on here is significant. If you've done anything that is a change in the way that you account for the stock options, you want to make sure that this is deemed by the auditors as a refinement or an adjustment to the policy and not a change in accounting policy. Because if you change your accounting policy leading up to an IPO, either the audit firm or the SEC upon review of your S-1 may say, hey, that's a change in accounting policy, and the SEC dictates that you can only change from one method to another if it's preferable. Oftentimes they'll turn around and then say to you, you need to get a letter of preference from your audit firm saying that what you switched to was a preferred method. So, you know, you don't want to encounter those delays and hiccups leading up to an IPO.
Yeah, I was just going to add one item on the cheap stock piece. It's not always just a tax issue, right? As Matt said, if you're interpolating or your auditors want you to interpolate or extrapolate between 409As, you may end up with cheap stock purely from an accounting standpoint, not necessarily from a tax. And ultimately, it just means that you're going to take a higher amount of expense. So cheap stock sort of has a bad rep, I think, but it's become more and more common that you're going to grant your options with an exercise price at the 409A value, but you may account for them at a higher value because you're extrapolating or interpolating between 409A.
All right, let's take a look at polling question number 3. How early are you interacting with your auditors before audit field work? Is it A, 1 month before, B, 2 months, C, throughout the year, D, other, or E, we're not audited today? I'll give you a few moments, and just as a reminder, you have to be logged in for 50 consecutive minutes to qualify for CE credit. We will be sending you a copy of the slide deck and a recording of the presentation within 2 business days. Okay, let's go ahead and close the poll.
So it looks like the majority of you are interacting with your audit firms throughout the year. That's a good thing. Oftentimes when we're auditing pre-public companies, it's sort of an afterthought, and I've got many temporary controllers and CFOs that sort of midway through the audit will say to me, oh, I thought you were going to do that. And the answer is certainly your auditor in the private company stage can do that, but then they're going to likely give you a material weakness for your inability to prepare those footnotes. And certainly as you're leading up to the IPO threshold, you're going to want to have those capabilities in-house, because the auditor is not going to want to be put in a position where they are preparing any element of your financial statements or footnotes.
So a quick update. The FASB has been working on trying to simplify, clarify, etc. Some of the guidance around stock-based compensation. And so they last year actually announced a clarification. So it was somewhat vague on what happens if there's a performance target that could still be achieved after the requisite service period. And basically they've now clarified it that if the target is going to be, it can be achieved after the requisite service period, and it's not going to be reflected in the grant date fair value as long as it can be estimated and it's probable. So the cost is still going to be recognized in the period when the achievement of the target is probable or occurs, right? In the case of an IPO or change of control, it may actually not, you may not record expense until it actually occurs. But in the case of a revenue target or something else, where when it becomes probable, you're going to begin recognizing the expense. So that's not really changing. What the clarification was about was whether or not to estimate it in the grant date fair value. Ultimately, if it is a performance condition, then you're not going to reflect it in the estimate of grant date fair value. A quick example, basically, if a company grants the awards and the options can vest, from now until 10 years upon a change of control, but the employee terminates in between at year 4 and they can still vest. If the change of control happens in year 5, that's when it becomes probable. The grant date fair value of $100,000 doesn't change because of the probability of the change of control. And ultimately, you would recognize that $100,000 in year 5 when that change of control occurred. So pretty simple and subtle, but if you were to include the probability into the grant date fair value, it adds a lot of complexity to your calculation, whether it be a Monte Carlo or lattice model or something more complex, in order to take into account the actual probability of that change of control event. So basically you have at December 15th of this year, 2015, you have to begin to adopt this. You could also adopt it earlier and retroactively if you want to, and you have to present everything in the financial statements accordingly, or any awards that have performance conditions after December 15th, then you'll have to apply this principle. So pretty subtle change and clarification, but just kind of giving some guidance exactly on how you handle those performance awards, and you don't necessarily need to take into account the probability in the grant date fair value. So we're going to go on to another polling question. Keep you guys engaged out there.
That's right. And the question is, who manages accounting for your equity awards? Is it A, internally, you're doing it with a software tool? B, you're using spreadsheets? C, external consultants? D, no one, the software does everything? Or E, other? Please go ahead and make your selections. I'll give you a few more moments to choose. Okay, let's go ahead and close the poll.
Nice. So it's good to see that almost 50% of the group is using software. Definitely still have some folks on spreadsheets. Again, as you continue to grow, you'll want to look at using a different system to calculate that, external consultants. I'm glad to see that nobody is just allowing their software to do everything. As Matt touched on, it's important to understand not only the buttons to push and the parameters to set the system up at, but also to understand the calculations and what actually comes out of the system. So now we're going to talk a little bit further about modifications. We've touched on them and the importance of tracking them, and as we saw from the beginning poll, the very first polling question I think was about, have you had these certain events occur? Ultimately, a modification is any change in the terms or conditions of an award. It may or may not lead to accounting impact, but there may also be tax or other ramifications. But that is the definition of a modification under ASC 718, and thereby you need to do some sort of analysis on whether or not there is an accounting impact. It's treated as an exchange of an original award for a new award. You'll see many of the systems actually treat modifications as such, so you cancel the original award and reissue a new award. And then you're going to recognize expense, potentially incremental expense, depending on the modification type. So some of the ones, there were, I think about 30% of the folks or maybe 20% of the folks that said they had some repricings done. That's a pretty obvious broad-based modification. That's one where we definitely recommend you getting the auditors involved, getting tax help involved to make sure you're doing everything properly. A business combination, and we'll talk about that in a moment, that's also going to be potentially drive some modification accounting as well. Or the reclassification of award from equity to liability or vice versa. Some of the ones that are commonly overlooked, although again many people called them out, so we're glad to see that. If you accelerate somebody's vesting, you give them more time to exercise, you may change the award type from ISO to non-qual or adjust the performance conditions. Again, sometimes a reclassification of an award can also be commonly overlooked. Repricings are pretty simple. The value of the company stock has dropped and the company wants to change the option exercise price. But some of the other ones maybe happen on back of a napkin or a consulting agreement where you really like that person and they provided you 8 months of great service, and so you just you allowed them to just exercise, 25% of their shares without documenting that or recording any expense associated with it.
And another thing we've seen often on the audit front is employees, and again, this applies to early stage companies that make heavy use of consultants or part-time folks. Oftentimes, once those employees demonstrate themselves, once the company gets the next round of funding, they're ready to bring those employees who were consultants on board as full-time employees, and oftentimes there's not an analysis or evaluation done of that change in employee status, and that is significant because all of a sudden the way you account for those options changes the minute they sign on board as a full-time employee. So make sure you're considering that as you evaluate whether or not you've had any modifications.
Yeah, definitely agreed, seeing that overlooked as well. And a lot of times if you have a system, they'll help you in that process. But again, you have to know how to apply the valuation assumptions. So as far as the fair value piece, you're always going to do an analysis as of the modification date. And for equity awards, it's going to be based on the probability of vesting. So you're going to compare the fair value of the original versus the modified award. In some cases, the fair value of the original may be 0 if it was improbable of vesting, and so therefore you're going to just take the full amount of the modified award. With the liability awards, they're going to be remeasured at each reporting period anyway. So at the modification date, you simply need to recognize the new fair value of the modified award using the modified terms. So that is if it continues to remain a liability award. As Matt said, if it changes classification, you might have to reclassify the liability, under APIC as opposed to the liability, and revalue it as well. So talking about modification accounting, again, with pre and post calculation, the next slide I think is going to add a lot of context to that. But make sure you document how you're accounting for it, whether it is equity liability, whether it's changing from equity to liability, if it's employee to non-employee. As we've discussed multiple times, getting your audit team involved is definitely helpful, and documenting the calculations as well. So not going to go through this slide in full detail, but there's 4 different types of modifications. Really, there's 2 main types of, most common types, there's the type 1 and the type 3. The difference being that in a probable to probable, and we're talking about vesting, right? So if it was probable that the award was going to vest before the modification and still probable it's going to vest, then you just look at the before and after and you take the incremental expense if there is any. And so an example of that might be if you extended the term for somebody to exercise, you gave them a year instead of 90 days, well, that's going to be a probable to probable. Improbable to probable is going to be more on that accelerated, where you've accelerated somebody's vesting and gave them shares or options that they wouldn't have otherwise achieved. And in that case, for those shares that they wouldn't have otherwise achieved, you're just going to take the full fair value of those shares on the modification date. And that, in that case, could be less than the original grant date fair value. So when it comes to M&A, and it sounds like there were a few folks that did some M&A or acquisition activity, the big question becomes whether you have an obligation to replace the acquiree's awards. And this may be a legal question. It dives into the merger agreement. But if you don't have an obligation to replace the acquiree's awards and you simply have anyways, then that expense is all going to be post-acquisition. If you have that obligation, then you need to do some further analysis. And the analysis really is to bifurcate between purchase consideration and post-transaction expense. And the value of the award immediately before, again, it's the same kind of pre and post, that value times the percentage of service completed is going to be your purchase consideration. And then if we take the value of the entire award immediately after the acquisition, so right after, then minus the purchase consideration, that becomes what you're going to record as post-transaction expense. A portion of that may be immediate. The rest of it you're going to amortize over the remaining life. Again, some nuance here between a general modification and M&A is in a general modification you might be looking at vested versus unvested shares, whereas in an M&A scenario you're actually looking at percentage of completion, percentage of service completed versus vested or unvested. You may also have some incremental expense that you have to take. So if you have an excess of the post-transaction expense over the purchase consideration, in some cases it's kind of analogous to a bargain purchase, if you will. You have to take some excess expense there. It's pretty complex. Definitely want to go through it with your audit team, potentially consultants, and legal needs to be involved as well because the merger agreement plays into it. Other considerations on M&A, if you have change of control provisions, then there's not necessarily modification accounting. You're just going to accelerate that expense, and that usually goes on the acquiree's books. If there wasn't a change of control provision, but you did accelerate the expense, then that's actually going to go on your books as the acquirer. There may also be a tax impact, right? If we're accelerating awards or we're changing, we're assuming the awards, they may or may not still be qualified as ISOs in that case. So again, you want to consult with tax folks. Let's go ahead and get to our fifth polling question here.
Okay, and the question is your company anticipating an IPO within the next 12 months? Is it A, yes, B, no, or C, not sure? Okay, let's go ahead and close the poll.
Oh, it's interesting. I think if you asked this question probably 2 years ago, everybody said that they were contemplating an IPO within the next 12 months. Perhaps it's more like 12 to 24 months, but that's interesting to see. Like I said, we've seen a little bit of a slowdown in the IPO market, but a lot of companies, especially startups, that think, hey, we're going out pretty soon. So we're glad to see people are more realistic about the time it takes to get out, because it's definitely more than 12 months to start preparing and going through it. And we're going to talk a little bit, Matt's going to talk a little bit more about how to start preparing.
So again, I think key to preparing for readiness is just making sure that you've defined who it is that is going to respond to all of the audit inquiries, who it is that ultimately is going to make sure that this stock compensation is accounted for properly and booked. Make sure that you've got that in writing, and then to the extent there was any communication between employees or non-employees that were granted options, you're going to want to go back and gather that audit trail. And down here you can see certainly the older the plan, the more likely you're going to have data issues. I can recall one circumstance where we were actually at a S-1 drafting session, and the CEO left the drafting session to go back to his garage to dig up documents that were employment agreements because they impacted stock option accounting. So you don't want to put your founders of your company in that position. And I mean, what is interesting here is oftentimes companies are going through the audit process and they're saying, hey, we're only going to get audited for the most recent 3 years, so that's all we need to focus on. But FAS 123R, the original pronouncement that mandated stock options suddenly hit your P&L instead of being a disclosure only, was adopted back in 2006. So if you haven't done accounting for them and the company is that old, yes, you do need to go back. I had this argument with a client recently, and they said, what does it matter? And because ultimately it's just a reclassification between stock compensation expense, so that ultimately it's going to flow through retained earnings and additional paid-in capital. But it is a equity item that is significant, and if you've got an audit firm of any quality, they're going to make you go back and do option accounting back to the date when it was required. And then certainly quarterly expense as a company is leading up to an IPO, you got to make sure you're doing it not just on an annual basis, but you're analyzing that expense and recording it on a quarterly basis. We've already talked about valuations. Oftentimes companies will not have gotten contemporaneous valuations, especially if the company's been around and sort of fledgling, struggling for many years. So you're going to need to go back, and certainly those valuations that are being done on a non-contemporaneous basis are going to get more scrutiny from your audit firm. And just make sure, again, that leading up to 18 months prior to an IPO, you are starting to think about at least semi-annual, if not quarterly, valuations for those stock options. And certainly after the company goes public, there is a significantly greater burden on the company to focus on maintaining the tax detail for each option grant. We've actually got a guy with our firm that his almost entire practice is surrounding stock option and all the complexities of tracking those particular tax attributes for each option, because there's significant tax benefit to the company. You can reduce your taxes payable based on options that were either exercised and or ultimately the underlying shares were sold. Certainly, even for R&D cost sharing, that's something that you're going to want to make sure you've got proper allocation of the tax attributes for. And so, the clear message here is make sure you've got a system that is capable of tracking those tax attributes. And if you're declaring tax deductions on your return, you're going to want to make sure you're maximizing those and you have appropriate support. So make sure you got the right system in place.
Yeah, and another kind of change is going to be EPS, right? Obviously, as a private company, there may not be any basis or importance on EPS, but when you go down the IPO path and then you become a public company, that becomes very important. Just real briefly, basic EPS is just your common shares, but you are going to have to remove the weighted unvested early exercise shares, or again, many startups are granting restricted stock awards. So those restricted stock awards, while legally are considered outstanding stock, for accounting purposes, you need to remove them, the unvested shares as well. On the diluted side, things get more complicated. If you're in a loss position, the nice thing is that you don't have to disclose diluted EPS. It's the same as basic. But if you are profitable, which is probably better, you then have to look at stock options, all of your dilutive issuances, preferred stock, all of that. And for stock-based comp, there's the tax benefit, the proceeds from exercises, and the unrecognized expense that all go into potentially, or theoretically, I should say, buying back shares and reducing the number of shares, diluted shares that are outstanding. Also need to do an analysis of whether an award is dilutive or anti-dilutive, and that all goes into those components of dilution. Some of the administrative changes that we recommend and some clients make earlier than others, but is shifting away from ISOs to more non-quals or RSUs. As Matt said, we've seen more companies kind of shift to RSUs in general. Also a shift towards performance awards, which may or may not be a good thing, just depending on how you structure it. There's a lot of complexity when it comes to performance awards. You know, you saw the FASB is simplifying it or clarifying it, but there's still a lot of complexity. Discontinuing early exercise, again, because of the EPS ramifications and also the tracking, it just becomes easier to discontinue that. Modifications we talked about. And then ESPP, employee stock purchase plan, we definitely see a lot of companies right after they go public or maybe in conjunction with their IPO is when they start their ESPP, which is a great benefit to employees, but another new thing or item, equity item that you need to account for.
Okay, great. So let's do the last polling question. Cheap stock can refer to options granted with exercise prices above the FMV. Do you think that's A, true, B, false, or C, not sure?
And for those of you that don't know what FMV, fair market value.
We'll give you just a few more moments.
And this is our last polling question for all you that are tired of clicking your responses. This is our last one. So
all right, great.
So this is a little bit of a trick question. So the answer is false, right? So cheap stock actually refers to when the exercise price is below the fair market value instead of being above the fair market value. When the exercise price is above the fair market value, it's actually considered a premium option. It's out of the money. The concern with cheap stock is when it's in the money. So we're going to go quickly through some updates that the FASB is working with the Private Company Council. So for those of you that don't know, the Private Company Council is an organization or a committee that the FASB established to try and simplify standards for private companies. One of the things on the table right now is simplifying the expected term calculation for grants that have performance and service conditions. So today as a private company or even as a public company with certain conditions, you might be able to use the SAB 107 simplified method, you know, the weighted average between the vesting period and the contractual life. But with performance conditions, you historically weren't able to do that. But now the FASB is contemplating making that available if there's a performance and service condition embedded in one award. So it'd be very nice, and even if you couldn't use it at grant date, you could use the contractual term. So the other piece is that there's a one-time change in accounting principle related to liability awards that you could make. So most companies don't know that if you have liability awards, you could inherently elect to value them at intrinsic value versus using fair value if you're a private company. Now, if you're a private company and you've historically been using in fair value, you can actually make an election to, or they're contemplating you being able to make an election back to intrinsic value. So again, simplifying those awards that you have to revalue at every period using intrinsic value. A lot of this comes from the discussion of whether private company options are even worth very much, and the discussion around that. The last kind of piece is the aligning of public and private classification guidance, equity versus liability, and kind of making that consistent and considering the probability of occurrence to determine the classification, as opposed to just having to decide one way or the other. So the FASB is trying to simplify this. More to come. They actually met in February of this year, so more to come on this. But we'll see. It's a good thing for those of you that are private companies out there, and that's private. Just so you know, that's private company defined under ASC 718. So that means you have equity securities traded on the public markets, you're filing with a regulatory agency, or you're a subsidiary of a public company. Not going to go into IFRS, as it's probably not overly applicable to many of you, but they are also looking to simplify some of the IFR guidance. I think one of the big ones is around if you have cash settled awards, or you allow you allow your employees to withhold the cover or sell the cover. Instead of treating that as a liability, they're looking at making that more of an equity classification, similar to GAAP. So in today's webinar, we've kind of talked a lot about being proactive, not only with your auditors, but just with your entire equity management process, whether it's documentation, communication, and working with outside firms and your auditors ahead of time. Working on your S-1 or getting to that year-end stuff, working on that ahead of time. Again, being proactive versus reactive. We think avoiding plans in Excel going to help you simplify the process, get rid of some of these risks, etc.
All right, thanks, Scott. And so on the screen, you'll see our presenter's contact information. Actually, not yet. Why don't we open it up for questions? We may only have time for one or two, but if you have any questions for either Scott or Matt, please go ahead and submit them now.
So it looks like we do have one question in here that we're going to be able to get to. If you do have other questions, please feel free to submit them. The question is, what about pricing the options at the latest round of funding? I'm not sure specifically what you're referring to, but typically just valuing the options at that latest round is not going to be an accurate representation of what A, your common stock is actually worth, or B, what the option is worth, right? The common stock takes into account, less all the preferences and anything that may go into that latest round. In addition, your option price, right, your value, your Black-Scholes value or your fair value isn't going to be just the value at your round. So you'd have to take into account other assumptions to get to the fair value.
Often what you'll see is stock options that are papered so that it says the value or the number of shares is very specific with the employee and the underlying type of share is, but then they leave open the exercise price and they say the exercise price will be determined at the next 409A valuation date, with vesting actually that happens based on the it'll be sort of retroactively vested back to the date that the employee was brought on board. So that's one way to solve the issue and concern about granting options that may be cheap.
Yeah, I definitely don't want to be putting any exercise prices in your offer letters. That's a no-no. As Matt said, just keeping that a little bit more vague and open to the next board meeting or 409A evaluation.
All right, great. So now you'll see our presenter's contact information in front of you. Please feel free to reach out to them should you have any further questions. Thank you for participating in our webinar this morning, and as a reminder, all participants will receive instructions to access their certification of completion if they met all of the CE requirements. And as you exit the survey, as you exit the webinar, please take a minute to fill out our brief evaluation. It helps us improve webinars for the future. And lastly, I'd like to share that Armanino is hosting a Cloud Solutions networking event on Tuesday, March 3rd from 4 to 7 p.m. If you'd like an official invitation, please feel free to email the email address on the screen above. Thank you so much, everyone, and have a great day.
Thank you.